How do you build a portfolio? You're accessing your equity, perhaps in your home and in the investment property, and you're looking to buy that next cash flow positive property that will build your portfolio. The way you determine the length of time this takes is, should you refinance to buy another property? Absolutely. You have to stay on top of your risk and you need to manage your finances. Can this refinancing affect your credit score for your future borrowing capacity? Yes. Everything affects your credit score. This is why you need a... Welcome to the Passive Property Investor Podcast, where I teach you how to stop trading your time for money with property investment. I'm Jerry Parker, your property investment consultant. Let's dive in. Hey, today I want to talk to you about refinancing to expand your portfolio or just to buy a second property. Who is this for? If you have a property, maybe you bought it a few years ago, it's an investment property and it's gone up in value, which a lot of people have, and so you've got some equity there. Creating wealth with property is utilizing that equity. At times, sometimes I call it lazy equity. So how do you go about doing this? Well, you need to go over, this is starting back at the first beginning, you go over your assets and liabilities. You need a valuation on that property and to know what it's worth. And it's not so much what it's worth in the marketplace, but what it's worth to a bank. So it's the bank's valuer will value that. And you know, you've got a deal with the bank, and it's the solid deal that everyone's got with the bank is they will lend you 80% against that property. And if you have some excess equity there, well, you have a good chance of getting a loan from the bank. They will also assess you on your income as well. And rule of thumb is they will consider that you cost yourself about $50,000 a year to live. And then they will take the rest of your income and they will multiply that times 2.5. And they want to see you be able to cover your interest payments by that amount. It's just a quick ready reckoner on that. Seeking a mortgage broker to help you through this makes it a lot simpler, and you'll need to do that anyway. So you assess how much you can borrow against this property to be able to refinance it and draw more down out of the property. You also need to take a little bit of an assessment of your personal risk, because if you refinance and you draw more money out of the property, you know you're going to be responsible for those interest payments. So anything that you do with that money, it needs to be able to cover those interest payments. So you've looked at your first property bought and you see that there's equity there, and you think to yourself, should I draw down on that equity and invest into another property? Well, it's what I call becoming a capitalist. You're first stepping in to learning and experiencing how you make money with money and not by working for it. And this is money that you've earned, and you can access it through the banks, and you don't pay tax on that because it's debt. And you take that money and you invest it into another asset that goes up in value again. And what this creates is a bit of a snowball effect. And if you just stay with one property, it's not going to actually replace your income. It's not going to take you to the promised land, like I like to say. But once you start building this portfolio and it starts to snowball, like going downhill, it gets bigger and bigger all by itself. And eventually it'll get so big that you make more money from that snowball than you could ever work for in your life. Like, for instance, if the property is $600,000 and it goes up by 10%, and then that's $60,000. But if you have two, it goes up by 10%, well, it's $120,000. Or if you have three, it's $180,000. And if that happens every year, or maybe it's 5% one year or 15, 20% another year, well, this is how the rich get rich. And this is the opportunity that you've created yourself with this equity that you have in your property. So you ask me, should you refinance to buy another property? I say absolutely. And this is what you're trying to do as a passive property investor. You don't want to sell that property because you pay tax, but you want to keep this game of capital growth going. And 50% is the banks. It's getting the money from the banks safely. This is how you print money. Just like the government prints money, you can do it too, and you buy assets and you make money without having to work for them. So you have to stay on top of your risk, and you need to manage your finances, your cash flows. Okay, let me tell you some problems that people get into with the refinancing. They're not doing it in quite the right way. So let's just say you've got your house, and then you've got this investment property that you've bought. Well, you keep your house safe. You don't want if things go bad, well, you don't want the bank will come after your house first off, unless you have it protected. So you have one bank for your house, and then you have another bank for your investment property. And then if you're going to use equity from that investment property, you use another bank again. And you don't cross-collateralize. You don't allow the bank to have a mortgage over your house or your other properties. And that way, Bank A protects you from Bank C. So they can't come after that property because you're protected by the other bank. So they have to stay with the property that they have their mortgage with. They can't use your personal guarantee and go over and take that property from you. Another pitfall to when they refinance to buy another property is they don't match their cash flows. They get overexcited and they buy a cash flow negative property so they don't have their interest covered, and they start having to tip in money from their earnings or their savings to cover these interest payments. You want to remain cash flow positive, and looking at taking a tax assessment of how much tax you're going to get back helps you become tax flow positive. So you match your cash flows. It's a great idea to look at after you've got this first investment property to use the equity in that to get your next property. And it comes down to your plan and your goals. Like here's for instance, if you want to have $100,000 a year in passive income, and that's what you've set as your goal, and you could perhaps retire on that. Well, the return you'll get from the stock market or the property market, the conservative term return is 5%. So if you have $2 million, your house paid for, and $2 million in equity in property, that's like after the debt, and you're getting a 5% return on that, that's $100,000. So if that's what you've set as your goal, and now you're going to build this portfolio that gets you there. So how do you build the portfolio? Well, there's different stages. There's the accumulation phase to where you're buying the properties. And then there is the holding phase to where you're allowing them to snowball in capital growth. So when you're in the accumulation phase, you might need, if the property is going to double every 10 to 15 years in value, and the value of the property, this cash flow positive, say, is $600,000 or $700,000. Well, how many properties do you need? If it's in 15 years and it's 700,000, well, you'll need 4 properties to double in value for you to get to your $2 million goal. So it's a financial modeling that helps you determine how many properties you're going to buy. And then say you're in the accumulation phase. You've got one, and you need to get the next one. Well, this is a careful risk management process to where you're accessing your equity, perhaps in your home and in the investment property, and you're looking to buy that next cash flow positive property that will build your portfolio. So it might take 2 or 3 years of this accumulation phase, or even longer. The way you determine the length of time this takes is based on your own earnings, about how much tax you're paying, how quickly you're building equity. It's a stepping process to where you earn income, you pay too much tax, then you buy equity that helps you reduce your tax, and you need your equity go up, and then you're earning more income, and then you buy another piece of equity. So it's like walking up a flight of steps, and you do it very carefully and over time. Can this refinancing affect your credit score for, say, your future borrowing capacity? Yes, everything affects your credit score. But there's this thing that you get with banks, especially with this strategy that we do. We use a different bank with every loan, with every property, and we don't consolidate and we don't cross collateralize. And this is the game that we play. And this is why you need a good mortgage broker, one that understands property investment, that knows how to go out into the market and compare loans and competitively put you in front of different banks that are looking at different types of borrowing. The game that we're playing with banks is a game of information asymmetry. I mean, it's like what you know about me and what you don't know about me. And it's the same thing with the banks. They're trying to get you to pay higher margin to them based on the way they view your riskiness. If you seem more risky, they'll give you the money. They just want to charge you more. But you want to seem very safe to the bank, and you don't want them to know everything in your closet that could be bad for the bank. So you hold back information from them, and they hold back market information from you. But in somewhere in the middle, you guys finally work out a deal. And you use brokers to help you sort this information asymmetry out. Here's some pitfalls that people do fall into with their, say, their credit score. There are no-nos. There is this thing called good debt and bad debt. And you're going to really flag, if you've got a lot of credit card debt, that's going to flag you a bad credit score. Or if you have a debt on assets that don't go up in value, like cars, or sometimes if you have a big mortgage on your home, that's going to hurt your cash flow. You don't look as strong to the banks. So in this little game of information asymmetry, you want to make that look really good. So when you're presenting to the banks, and it's good to have the professional mortgage broker that knows how to present you as well. Okay, so let's just say you have an investment property and then you've got your home and you've got loan against each, and you don't want to refinance because it seems risky. You just want to keep everything the status quo just as it is. You know, I could say to you, it's more risky to not run your finances in a optimal way than it is to just pay extra for no reason because you're afraid of looking at the risk. You're afraid of the dragon. You don't want to look at it. It's so scary. You don't even want to look at it, but you have to stand up, face the dragon, and see where you're at. And if you don't want to invest, you know, if you have the opportunity to remortgage this second property, take the money out of the property and put it in an offset account against your home loan and reduce your home loan debt, because that is non-tax deductible. So you've increased your tax deductible debt, but then you've put an offset and reduced your non-tax deductible debt. And that's just being smart and operating your finances in a better way. And you're not going out into the property market and taking that risk. You're just reducing your overall financial risk and reducing your tax. So at least look at that. 50% of your investments is the finance. So it's so important to have the right people with you, a good mortgage broker or two of them, and always stay on top of where you are in terms of your assets, your liabilities, and your cash flows. Financially managing your life is extremely important, especially if you want to be a wealthy person, if you want to be a capitalist. This is the job. This is all you do, is just manage your finances and your financial life to get what you want. And it's better than just trading your time for money for your whole life. So if you want to know more about this, or if you want me to help you understand how this can work out for your financial situation, you know, click on the show notes below. Just reach out to me. I'll happily speak with you and do what I can do to answer all your questions. And I'm not going to charge you anything. Questions answered for free. Just check me out and we'll see what we can do together. Hey, thanks for tuning in to The Passive Property Investor. If you enjoyed this episode, the best way to show your support is give a 5-star review on Apple Podcasts and Spotify. Make sure you subscribe to the YouTube so you don't miss a single episode. We're on all social media platforms, so feel free to connect with me there. And if you're having specific problems making your first investment or building your portfolio, maybe you don't know which location to invest in, how much you should invest, you're worried about who to trust, reach out for me down below. I will have the answers for you. Don't hesitate. See you on the next episode.